So, by way of introduction, my name is Marissa Trew from Aptos Labs, and I am joined today by Graham Rodford, CEO of Archax, the first FCA-regulated global digital securities exchange, and Ryan Zega, Head of Structured Finance at Aptos Labs. So, we are currently spanning 3 time zones. We're in the UK, Singapore, and New York. What we're going to do is kick off with some pretty big news. Archax has just announced its integration with Aptos to expand its range of RWAs on chain. So, Graham, can you tell us more? Like, what does this integration actually look like in practice? Who's it for? And why does it really matter?
Yeah, sure. So thanks for having us again. So Archax is a regulated securities exchange broker custodian. We live in that world somewhere between traditional securities and digital products, and where they cross over digital securities, that's our expertise really. We've worked with a number of financial institutions over the 8 years we've been around, notably Aberdeen, BlackRock, Legal & General, Fidelity, and we've been tokenizing their funds like a lot of the good players in the industries. But we've also got more as well. We can tokenize equity and debt. And as a firm, we kind of believe in this space. We believe every single asset moves on chain, as well as every piece of infrastructure, and we're kind of building that eventuality. And we've known the Aptos team for a while, a good team. The chain is well suited to what we're building on. So we've been working together and decided to integrate them into our stack. So what that means now is that every security that Archax has access to, over 100 funds, every equity, every debt that Archax can custody, we can now bring to Aptos.
So, can you walk us through a little bit about the selection process when it came to Aptos for your integration?
As a firm, we're generally chain agnostic, but that doesn't mean that we work with anyone. We're constantly looking for things which we think are attractive to institutions. So first and foremost, I always say it, but teams that we like to work with, that's really important to us. We want to work with people that we need to talk to on a regular basis. The chain needs to be capable of dealing with fast transactions, as Aptos is. It needs to be an institutional network and understand the power of securities and not just one aimed at crypto. If you're ever going to sell to the institutions we talk to, you need to have good answers for how your network operates, how fast it is, all of these sorts of things that they care about. These things, when they get announced, everyone hears about them, but there's months in conversation before, understanding a bit about each other and making sure there's alignment.
So, it's all about finding the right fit for basically everyone's interests at hand. And, Ryan, to look at the other side of the coin, what makes this integration so significant for the Aptos network? And then how does Archax actually fit into the broader strategy and roadmap?
Yeah, definitely. Great questions. We've known the Archax team for, a number of years so far. High quality group, really working with a number of high quality issuers on both the debt and equity side. So we're looking at a number of different things from issuers. We want sort of best in class types of firms. Two, we're really looking to expand the set of RWAs that are accessible via Aptos as well, right? So we think that positioning with our checks globally will provide a meaningful impact to investors that are looking for assets that have been issued on Aptos.
And the interesting detail about this announcement is that the first asset being brought on chain through the integration is the members cap tokenized global reinsurance income fund. What is the significance as the first RWA being issued by Archax on Aptos?
We know the members cap team well as well. I mean, a lot of people are tokenizing money market funds, which is great. A lot of people looking at treasuries, which is also great, but a lot of people haven't moved beyond that. Some people are considering moving up the risk curve to corporate bonds or private equity, but everyone's kind of looking for new original things to invest in. So stablecoins are obviously taking off. And as well as tokenized deposits for banks, and that's great, but they need to be able to buy stuff, and money market funds isn't the only asset that people want access to. So members cap reflects access to an insurance product that isn't available elsewhere. Archax was speaking to them separately about tokenizing their product anyway, and I believe they were speaking to the Aptos team about participating in their fund and more generally in the company. So bringing those two together kind of makes sense. In addition to that, the London Stock Exchange has been working on their digital market infrastructure, their DMI, and members cap actually was one of the first, if not the first, products brought to DMI as well. So you've got members cap available tokenized through the London Stock Exchange. So it really was a big announcement.
And then again, back on the other side, the Aptos Foundation is a general partner in the members cap fund. So what does that actually tell us about this involvement? I guess the connection between all three and what it signals.
Sort of a similar thought process to before, right? Working with high quality partners to bring on additional asset classes into the Aptos ecosystem. So with MemberCap, we really enjoyed the fact that they're focused on reinsurance, which is a category that is quite large globally, right? For many investors has the right level of risk adjusted returns. And then for us, it kind of complements what we've already done with a number of institutional groups, right? We have BlackRock's Biddle Fund issued on Aptos, Franklin Templeton's Benji Fund, issued on Aptos. And then to Graham's point, right, both are tokenized money market funds. We have a number of private credit products that are issued on Aptos, including Apollo and Brevan Howard's funds. So, in order to add kind of something in the reinsurance sector, that's very exciting for us. And then we would love to do that and have done that with what we see as a best in class team.
So to zoom out a little bit and expand this conversation beyond this announcement, if we are to look at the RWA landscape at large, the key theme that both of you have mentioned is that this is about diversifying the assets that are being brought on chain. And, we're a little bit into 2026 now. How would you actually characterize the current state of RWAs and asset tokenization more broadly?
We're seeing continued and heightened institutional interest in utilizing blockchain technology for a variety of different processes. In late 2025, the DTCC received their no action letter from the SEC, which has prompted a lot of discussion around tokenized public equity. And then within DeFi markets, we have a number of high quality teams that are issuing derivative instruments for tokenized public equity. So I think that's like a good little sliver of what's going on, not only within sort of tokenized public equity, right, but broader financial markets as established players are looking at, where can blockchain be implemented? How does it interact with, broader global capital markets? And this is something that we're extremely excited about. RWAs are a very, very broad category. And I think, we continue to really dig down into best in class players and then trying to work both with TradFi players as well as DeFi players in this space.
This is going on globally, I guess, is just to add to Ryan's. In the US, they're doing that. In the UK, we kind of had this, what are digital securities for a while when it was an overlap of crypto and securities, and most people realize they're just securities, and regulations are moving that direction. And I think the thing that's really exciting about the space is cash, digital cash, stable coins. When you've got cash and assets on the same technology, you can suddenly automate a lot of transactions that really you couldn't before. And at the moment, you've got stable coins, quite big on Aptos as well, actually, that are kind of out there. And outside of crypto, the institutional space needs something to buy. So it's great if you can go and buy money market funds, but what would be better is if you can buy equity, debt, you can borrow against them 24/7 using some of the things that we've seen in DeFi. So when we're speaking to institutions now, it tends to be a focus less on POCs of just tokenizing, but more on utility. How do we create something that people can exchange 24/7? How do we borrow against their RWA? How do we make these assets, whilst the same assets, more useful than they are to their traditional counterparts? So we believe every asset is moving on chain, and that journey is kind of starting now. I'm pretty sure that's going to happen.
So we're basically looking at a bit of an attitude shift when it comes to institutional participation. Graham, I know Archax operates across multiple jurisdictions. So how would you actually describe the current regulatory environment for tokenized assets in both the UK and Europe more broadly?
Well, it's generally heading in the right. So if I kind of think of things in terms of, graphs, bottom left to top right, it's heading in the right direction, but it never quite goes as direct as you'd like it to. It kind of wavers off the line. So every time there's a regulatory announcement, I mostly like it. The problem is you get people with DeFi objectives, crypto objectives, RWA objectives, but generally speaking, I think we're regulating things in the right way. We shouldn't stifle innovation, but we have to remember that a lot of those regs were there to protect consumers, and we've seen consumers hurt by a lot of things that have happened in crypto. So getting that balance right of allowing people direct access to products but using regulation as protection is going to be interesting.
I do think there is quite a stark parallel in terms of what's been going on in the US and the abundance of conversations around regulation. Are we actually seeing a convergence or a divergence in the way that the US as well as the UK and EU have approached regulation?
I think there's positive momentum globally. So like digging down to the US, you've seen a tremendous amount of stablecoin proliferation, right? With the Genius Act on Aptos, right? We transact, I think, 60 billion worth of stablecoin transactional volume a month. We're the second, most actively used chain for USDT, and then work with a number of the other, high quality stablecoin issuers, Circle, World Liberty Financial, Athena, and a bunch of others. So I think that was a good showing of, what regulation can do in sort of unlocking more blockchain native products, specifically stablecoins. We're seeing, similar momentum, right, in Europe with the passage of MiCA, right, and then usage across different jurisdictions. And then we have, very active participation in the APAC market, right? So we're working with the Hong Kong Monetary Authority with their EHKD Plus program. So we're the only phase 2 layer 1. We're working very closely with the member banks there on tokenized deposits and digital money, right? So I think there is like an overall, I would say, good progression. And then if you dig into the ongoing discussions around sort of the Clarity Act and other, other pieces of legislation, similar to what Graham mentioned, are kind of figuring out the role of existing players in infrastructure, more DeFi native players. Hopefully, you'll come to some sort of middle ground. But yeah, I think the progression has been quite good. And then, fingers crossed for another successful, year in 2026.
Brian made a good point there about the amount of regulation, because at the start of Archax 8 years ago, it was pretty easy for me to follow most new issuances and all of the regulations globally. But now, I wouldn't say that I don't try, but the FCA alone has stablecoin regulation, it has tokenized deposit regulation, it has securities regulation, payments, banking, whatever it might be. And then you're trying to go, okay, well, how can we work with someone in the US? And, Clarity, Genius, you've got trust banks, state regulation, Fed stuff going on, and then I look out to Singapore and see what they're going on. Now speaking to someone in Australia the other day, the reality is I can't keep up anymore. So you're reliant on having partners in different jurisdictions. Aptos obviously have a solid presence in the US as well, which is helpful for us when we're looking to do stuff together. Bringing together this regulation is not going to be easy, and unless you have the balance sheet to have a strong regulatory team everywhere, then these partnerships are important.
So we're talking about a lot of progress, but at the same time, we're talking about very different speeds, very different mechanisms. And it sounds like one of the core challenges is trying to reconcile all of the different systems and understanding what functions in what market, what doesn't function in another, and trying to find, I guess, the middle path.
Yeah, and Archax in the US, you have Securitize. I know they work closely with Aptos as well. We have been trying to work with that team since the start of Archax. And when we come together, you can just see where some of those frictions are. I'll say we're a professional investor, and they'll say, was that a qualified purchaser? And I'm like, well, I'm not sure. Let me go away and look at it. They'll say, can you tell me who your investors are? I'll say, well, I don't usually have to. And they'll say, well, we think you do because of this. Just when you're trying to mash this stuff together from a traditional securities point of view is difficult enough. And then when you start saying, by the way, we've got this token, it's a representation of a security in my jurisdiction, but I'm not sure the classification in your jurisdiction. There's just a lot to unpick there. So that's what a lot of people, I think, don't see that are excited about the space is sometimes the progress isn't, for lack of drive on the sides of the companies in the space. It's just working out how do we fit this into what is already in place to make sure that we can build something scalable.
So what does that actually indicate for how we move forward as an industry where we're talking about fragmentation right down to the regulatory level?
Working with high quality partners like Archax, right, that can kind of navigate jurisdictional differences, nuances around, investor types, and then kind of the proper handling, right, of securities, whether it's in a primary market or a secondary, is going to be, critical for, Aptos, right? And we're going to be doing similar types of partnerships globally in different asset classes where, there is this need to be nimble, right? But still kind of address sort of the broader capital markets.
Regulation is catalyzing a lot of participation, especially institutional participation, given the attitude shift that we spoke about a little bit earlier. A lot of conversations consider it sort of the defining factor in the next phase of adoption, and RWAs are a core pillar of that. Why is institutional participation more critical now than it ever was before?
I think size, 8 years ago, I think when Archax started and everyone's talking about tokenization, you just hear, fractionalization and 24/7. These things kind of could have been done before. People were kind of saying, oh, who's ever going to trade these things? That was kind of missing the point. The point is that they are the same things that already trade today, but with more utilities. As this market moves, it's not a question of whether Nvidia, Apple, Vodafone will have liquidity. It's always had liquidity. It's more, why will people trade it in its new form? And the reason they'll trade it in its new form is if you hold Nvidia as an individual, you can borrow against it 24/7. You can transfer it to someone and borrow against it. It makes investments have more utility to everyone, which should mean that if they get the same risk reward, everyone chooses that in the future. The problem is that a lot of that utility needs to be built, and retail is just not big enough on its own. A lot of them are trading crypto, and there's no point in them trading securities right now because RWA tends to sit outside of tax wrappers and pension wrappers a lot. But if you get the institutions, they have large amounts of capital. They can move markets. They can make it worthwhile developing utilities on their own. DTCC is a good example where they've come along and they're starting to look at tokenization. I mean, if they embrace tokenization, everything that sits on their ledgers becomes an on-chain RWA in no time. So I think it's a bit about size. And what's interesting right now in the market is this is the first time that I can remember that we've seen quite a big crypto sell-off without a loss in appetite for RWA. The RWA people I'm speaking to just don't even talk about crypto anymore. So we've managed to separate same technology, different asset, which has been really important, I think.
And then Graham hit on like an extremely important point, right? As we're having these institutional discussions around tokenizing different debt and equity products, tokenizing deposits, figuring out stablecoin utilization, right? And then how it could be either issued by some of these institutions or utilized within their ecosystems. There really is a divide between pricing crypto winter, right, versus crypto utilization by institutions. And that's a huge positive in this environment that was very, very different than prior years where pricing really commanded the progress of institutional discussion. So we're really excited about that. And then really kind of like digging into a really deep level of detail with a lot of these institutions, whereas previously it was a high level discussion around, hey, let's tokenize a money market fund, let's, tokenize a private credit fund. But, this is actually, hey, how do we implement blockchain, technology for cross-border remittances, kind of internal processes at different banks, obviously tokenized deposits, et cetera. So these are, positive discussions and really, good momentum going forward.
So it sounds like it's coming down to legitimacy, scale, and then also just the diversity of products that are being brought on chain. And as you mentioned, sort of this divergence between the original crypto ethos or what this industry was actually born from versus the utility that blockchain is actually serving today. But when we look at institutional participation more closely beyond, providing liquidity or putting their assets on chain, what does meaningful participation actually look like beyond that point? What happens next?
Well, so I think it's definitely started in the last year. The hockey stick has started to turn upwards. In the background, we've got about, at any point in time, 20 of the largest asset managers in the world that we're talking to about how do we tokenize this, how do we have a stablecoin share class, how do we have a natively digital fund. We're speaking to banks about tokenized deposits and digital assets marketplaces. And if we go back to that kind of original point of we think every asset's moving on chain, then I don't know where it is, Marissa, but the kind of answer is that there's 1.4 quadrillion of assets out there. They're all moving in this direction. So at the moment, it might only be, I don't know what the number is, 10, 20 billion, excluding stablecoins. But that number is going to tend towards a quadrillion of that, I'm pretty sure. And there'll be new assets that are created with technology that weren't possible before. So we haven't reached that kind of escape velocity yet. But the second you get a couple of these utilities in place, it's going to move a lot faster. I think it's important that we talk about AI as well, because AI is changing everything. As a tech company, I'm sure Aptos are as well. We're not scared to embrace AI. The speed that we've realized we can build things we need to speed this adoption up in Archax is pretty vast, and I know everyone else in our space is doing it as well. We're gonna see the tech and the capabilities move incredibly quickly, and as long as the regs are going to allow it, I think we're going to see faster building and shipping across the whole industry.
When we speak of escape velocity, is there a critical mass that you have in mind in terms of that's a signal that this truly is going to be a sustainable shift in our industry and capital markets more broadly? What other indicators do we actually have that this is going to be sustainable, it's going to be long-term, it's going to be permanent versus being an experimental exercise for these funds?
I think we're definitely beyond experimental already. I mean, it's being put into regulations and the likes of Larry Fink are out there saying this is going to change everything, and they wouldn't do that if they didn't think it was here forever, and the ETFs as well. So I think that bit's there. But I do like you're right. There's different metrics. For me, the thing that will prove this is here is when a big issuer, let's say Apple, come out and issue commercial paper first in natively digital form. And I don't mean a company that has an incentive to do it or couldn't raise money the traditional way and means they're doing a token. I mean a legitimate blue chip company is saying, you know what, why don't we go and be the first to issue our equity or our debt in this brand new form, and they'll only do that when the market is developed enough. So I think at that point there'll be no doubt that the market's moved in that direction.
Looking out 5 years from now, maybe tokenization as a topic is sort of less of a topic because that's just how, commercial paper issuance is done, issuance of, public equity, issuance of private securities. So that's kind of the, hopefully goal where you have enough critical mass going forward where all different types of markets are tokenized, and that's just the way things are done.
So then what are actually the challenges that go beyond regulation and the persuasion exercise of bringing institutions on chain that we've actually yet to overcome?
I mean, the crypto link was a problem. There were definitely a lot of banks speaking to us in the early days, say, look, you touch crypto, we can't talk to you. That's gone a little bit, especially if people are comfortable with public chains. They realize they need to buy the gas for public chains. A regulation, also not knowing where they stand. So those in the kind of the tech bit of the fintech, they were always comfortable to say, look, we're going to do it anyway and we'll worry about it later. But those guys that already have big financial businesses, they need regulatory certainty. So I think the kind of the initial barriers have gone, but then you still have kind of ingrained barriers which are a little bit more difficult. So for example, a bunch of institutions already say, but can we do this through the Swift network? Now, ignoring the fact Swift have now come out and said we're embracing this technology, before that it was a bit like, oh, okay, so we believe in blockchain, but we have to connect to the old world to facilitate them. Those kind of things were frustrating, but they're going away as well. And then internal sign-off, I still find a problem. I meet the strategic investment or the innovations guy, they're fully on board, then they need to go back internally, sell a team, and it goes up to a risk level or the CEO, and those guys are often like, well, this is just crypto, isn't it? You still need to get further into these firms, but I say that they're all realizing now, Jamie Dimon, Larry Fink are out there talking about it, so this isn't something that they can ignore anymore.
So a bit of a plumbing problem, but also still a bit of a reputational issue at the top.
Yeah, but disappearing.
The education piece is something that's really advanced over the past 5 to 10 years, right? Where Graham knows it, right? Kind of being in the industry where it was very much education first and then digging into some of the nuances of cryptography, blockchain utilization. And now a lot of these major banks have very well established digital asset teams. They're piloting their own programs internally. And then for us at Aptos, we're also working with a lot of high quality, third-party developers that are used to integrating, right, with legacy systems and implementing this blockchain technology. So education's still always going to be a piece of the puzzle, but really there's been a huge level of advancement and then huge focus on working with high quality sponsors going forward and not necessarily focusing in on some of the other projects that were, less reputable in the past within the crypto industry.
So then when it comes to this Archax Aptos integration partnership, how is that going to help bring us forward through some of these challenges?
Well, on our side, it's fully available now. So there are a number of advantages to the Aptos ecosystem. So anyone who wants to use the Aptos technology and needs to build a security, they can come to us. Anyone that's built a security and needs it to be custodied with somebody can come to us. Let's say Securitize and Biddle need someone in the UK to support them, then we can do that as well. So really just, being good ecosystem participants, that's what we intend to do. And then on our side as well, if someone comes to us and says, hey, which network should we be on, then we often introduce them to the network providers and say, look, you should talk to these guys, this is what they're focused on. So I know that everyone uses that rising tide lifts all boats or whatever the phrase is quite often, but it's definitely true. The industry is moving in this direction and it suits us all to accelerate it. And I think the way that you do that is networking, making as many introductions as possible and trying to talk about the capabilities that are available globally now across all the different participant groups.
It's a bit of symbiosis between the partnerships.
Exactly.
Yeah, totally. And that's kind of the goal on our end as well. We work with a number of high quality partners globally, and then sort of Archax, right, and their services kind of fit into a lot of those security oriented discussions. So it's great to have a high quality partner that's, fully integrated so that we can continue to get deeper and deeper on a lot of these, existing and then new relationships going forward.
So we spoke a little bit about curation and basically making sure that we add legitimacy to the industry rather than diluting it further. So what are some of the factors that are actually considered when evaluating on-chain products and understanding them to be credible and legitimate versus perhaps not?
From the Archax point of view, at the start of Archax, we were, I guess, commercially, we wanted to have traction, which meant we probably, kissed more frogs than we should have done. So anyone that said they were tokenizing something at the start, we met them, we understood their business, we spent a lot of time, which made us no money. I mean, of course, I don't think anything's ever a waste. You're learning, but we realized that there was a huge, there's a huge negative selection bias. Companies that would come to us and say, "Hey, I'm tokenizing my real estate development in, whichever place. I'm looking at tokenization." These people would usually fail to raise money in any other traditional form. So, you can't lead an RWA with a token. It doesn't really work. You might get lucky, but usually you need to lead with a product that makes sense. And so, we look at the companies now. We said, does this make sense? Are you trying to invest anyway? So people like Members Cap, it kind of made sense. It's a good product. It's in a regulated form. And as Ryan said, it has good risk-adjusted returns for a certain type of institutional base, whereas some of the ones we saw in the early days, they were never going to go anywhere. We'd never make money, and we were all just going and spinning our wheels. So, and we definitely put people through the mill now. And it's a bit easier when it's things like treasuries and money market funds or equity, because you can literally say people are trading this right now. Presumably they would trade mine as long as it's not more expensive and it has more utility. So that's kind of what we tend to focus on.
So it sort of qualifies the demand before you integrate it. And then on that basis, what are some of the categories of assets that are rising in demand at the moment?
To be honest, I'm not sure that I see the rise in demand for a type of asset. And why I say that is I think everyone says stablecoins are hot. There are still few stablecoins that are successful. I think people usually mean interest-bearing products, whether it's an earned product or a yield-bearing stablecoin or some variant. I think people earning yield is still a thing, but I think the thing people are really demanding is utility. So having a money market fund is great. Having a money market fund that you can exchange for a stable coin ad infinitum on a Saturday afternoon to go and buy Bitcoin is a lot more exciting. Or having one that you can transfer as a collateral payment is also more exciting. So I'm seeing people talk about corporate treasuries and private markets. I'm not really seeing more demand there, but I am speaking to a lot of institutions about it's great that we can tokenize money market funds, but actually what I would have a lot of demand for is if we could make it so it was transferable, used as collateral, exchangeable for stable coins, risk on, risk off. So I think it's the same products done better.
Right. Okay. So we're talking about expanding the utility of the products that already exist.
The composability of blockchain is a, huge selling point, and obviously it's going to be, dependent on jurisdiction and then the respective regulations. And then we've seen a lot of success with some of our larger global partners on getting deep, where we, may start with a loyalty points program, voucher program, something very high level. And, we'll continue to have that discussion and figure out something on, the payment side, right? Decentralized file storage side, maybe sort of implementing, wallet technology more broadly to offer a larger variety of product. So for us at Aptos, right, it's kind of looking at all the sort of tools in our chest that include high quality partners like Archax, and then also include different incubated projects, right? That decentralized file storage solution that I mentioned is, Shelby. And then we're doing that in conjunction with Jump Crypto. We're about to launch our incubated DEX called Decibel. So that'll be a good connective tissue within our ecosystem. When you think about different payment processing solutions, we're actually incubating Taps, which will be a good connectivity point with, both traditional Rails and DeFi Rails. So we're super excited to continue to make those connections to really advance the broader blockchain industry.
If we were to look at it as like a funnel, at the top we've got scalable participation and basically being able to tap into mass use, right down to the bottom of the funnel, which is more crypto native use cases and like fully on-chain products that will become more intuitive to use as the industry progresses. If we look ahead over the next year, I'd love to ask you both, what does success look like?
Ideally from this partnership, right? Again, it's bringing a, wider variety of debt and equity products, on chain on the Aptos network. And then, for us in Archax, right, it's also maybe like piloting other types of new programs. So we're, really excited to, get deep with the partnership, right, identify mutual clients that could benefit from both of our services, figure out, other potential ways to work together.
Yeah, exactly. Just, Aptos wants as much as possible on the network. The only thing to add is I like original things. I think if you can find a product that people want that can demonstrate a strength of the network, then that's always a good place for us both to be.
So the next pillar is, what does success look like over the next year in terms of the growth and expansion of RWAs?
I think we need utility. I know I've said it a few times. At the moment, I have so many conversations where, an institution meets me and they're like, but why would I ever tokenize something? And they don't know. And so then as I start to explain it, look, imagine you've got a money market fund, but it can't move. But now suddenly you can transfer it, you can borrow against it, you can send it to your friend, you can do that. They're like, oh, wow, I get it now. So can I do that right now? And I'm like, no, not really. And by the way, it probably costs more than its traditional counterpart. So all they're hearing is, I paid 2 bips for a money market fund today and I'm paying 50 in digital and I'm not getting any extra utility. So we need to better justify being able to use it. I'm not saying things don't exist, but they don't exist at scale right now. If you were to look at all of the RWAs out there, I think you'd find that most don't move around, which is if you haven't got that kind of velocity, then it's a sign that there's probably not much utility there. So I think we need to get that utility moving. And the good news is that by the end of this year, it will be good if there are decentralized borrow lend markets or vaults or whatever it might be, which kind of demonstrate that this utility that's been there for crypto at scale for a while can be there for RWA too.
Yeah. No, and I kind of echo the same sentiment. We need continued focus by regulators to implement new legislation, define what can be done on chain, what sort of participation legacy players and even DeFi entrants can have within sort of broader capital markets. And then on the other end, right, continued involvement by institutions. So both on the supply side and actually bringing high quality product to the market, but also on the demand side, right? And then potentially participating in these blockchain native types of products.
And this is going to be a very obtuse and final question. When we talk about, this eventual shift towards a fully on-chain capital market, if you had to place a bet on what year that would happen on a meaningful level, what would it be?
Yeah, it's tough to say. I think it's going to be incremental, right? You're going to see certain markets sort of adopting blockchain technology at different paces, and then there's also going to be the jurisdictional divide. So hopefully, 3, 5, 10 years from now, that RWA figure, right, whatever it is today, is kind of closer to that 1+ quadrillion, TBD on what it actually looks like. But again, we hope to see sort of meaningful increases going forward.
So anywhere within the next 3 years to the next decade. Graham, what about
I
yourself?
mean, yeah.
I was just going to say this year, to be honest. No, I agree with Brian. It's not. I mean, I started Archax 8 years ago, and it's taken 7 years longer than I thought it would back then. I mean, we built a central limit order book 24/7 that could handle thousands of transactions a second, and there's no RWAs really trading at that frequency yet. We built it for traditional securities flowing over, but I think it will. With the regulation foundation being in the institutions at the table and with AI, the technology is already here. So it's just about how fast we can move the market. So it's definitely not going to be this year. And 27 is probably optimistic. Yeah, I agree with Ryan. It's going to be incremental. So you're going to see it going in the right direction for this whole time. When does it really start taking off? Like, it's possible it's there by 30, I think. So I would say optimistically 29, 30 for, everyone to be doing it. Brian made a really good point earlier, and I meant to echo it, was that I think that is the real test of when it's there, is when, you're at a board level in a company and you're talking about doing an issuance, and everyone is not talking about tokenization because everyone just knows that it will be. And when you're saying to your friend, I'm going to send you money for tickets, they know it's going to be stablecoin. I think when it just becomes a way of life, that's kind of, we won't feel special anymore because we won't be able to use all these kind of terms everywhere. But that will be the sign that this really is the technology that everything's built on. So yeah, let's say 2030. Maybe we should touch base again then and see how well we're doing.
So effectively, when this conversation sounds extremely out of date, we'll know we'll have made it.
Yeah, exactly. Yeah. I mean, there's a funny video on our website at the start of Archax where we're saying everything will be tokenized kind of 8 years ago. And then, other than looking a lot different to I did then, it hasn't quite changed as much as I just thought it would.
Everything's always a hockey stick, right? When I joined T0 6 years ago, it's like everything will be tokenized, hockey stick approach, and then that sort of hockey stick is extended a bit. So I think things will progress going forward, right? It'll be incremental and then hopefully it'll be accelerated as well. So fingers crossed.
It's what everyone always says about little by little, then all at once. So hopefully you just wake up one day and realize it's happened and we just didn't notice it was going to be that subtle. Graham, Ryan, thank you both so much for your time today. It's been fascinating to learn not only about the partnership, but also RWAs, regulations, and basically the industry at large. So thank you again for all of your insights and your time.
Thanks, Marissa. Cheers, Ryan.
Thank you so much.